Exxon Mobil, as you mentioned, just out. And taking a look at this, the company actually came in with an adjusted loss of 18 cents a share. They came in with an actual loss of 15 cents a share. Both those numbers are better than the street's expectations. The street was looking for a loss of 25 cents a share. This is a very similar story to what we saw with Chevron early today, where they came in with better numbers than expected, a smaller loss than expected, or in Chevron's case, actually turned a profit on an adjusted basis versus the loss the street was looking for. But they did this not because of strength in sales or anything else. This is kind of, again, closely watching their spending and cutting back on a big way in capital expenditures.
That was a quick segment from CNBC reporting the loss by Exxon Mobil. And Exxon Mobil stock, let's go ahead and go to M1 Finance here, has had some horrible performance lately. And if you're wanting to get into the stock, whether you're a dividend investor or whether you're looking for a value investment, I think you should really be asking the question, will this company get back to the levels where it once was, back when the stock was $80 a share, $100 a share? Over the course of this video, we're going to go through all that. We're going to be going through the losses, the downturn in revenues, the dividend that they just announced that they will be maintaining in 2020 and even into 2021. They didn't raise it, but they are maintaining it. We're going to be looking at an article. We're going to be looking at some different opinions on both the bullish and the bear side for Exxon Mobil, and then give my opinions on it, comparing that. And then we'll also be looking at the balance sheet. I think for a company in this stage, the balance sheet and the income statement are very important in a time like this. And I want to compare it to a typical dividend stock, one that's had a downturn in 2020 but is recovering, which is one of the companies that I own. I want to compare it to Caterpillar and how the dividend policy relates to Exxon Mobil. But overall, guys, this is going to be a fun video. If you're not familiar with me, I'd invite you to subscribe. I'm a dividend investor, and we have 54 people now signed up with M1 Finance. So go ahead and use this link if you're interested and get $10 for signing up and depositing $100 to the platform. But going back here to Exxon Mobil. Exxon Mobil is about $32 a share as of today. And right now they have a quarterly payout on the dividend of 87 cents a share. Now Exxon Mobil just came out and said that they will be maintaining that 87 cents a share. Now what that means is that the company is going to continue to pay dividends even though they're having quarterly losses. Exxon Mobil reports third straight quarter of losses with revenue down nearly 30%. Exxon Mobil reported its third straight quarter of losses. During the third quarter, the company lost $680 million, although Exxon said results improved on a quarter-over-quarter basis thanks to the early stages of demand recovery. On an adjusted basis, Exxon lost 18 cents per share during the third quarter while generating $46.2 billion in revenue. Now, if we go back to M1 Finance, let's go ahead and look, like we said, they have to have 87 cents per share worth of earnings per share to even break even. Because this company pays out billions of dollars worth of dividends, if they don't make at least 87 cents a share every single quarter, then they are unprofitable. So they actually lost 18 cents and is still paying out 87. So really, if you think about it, if you factor in the dividend into this, it's really like they're losing $1 per share just in the last 90 days. So that is not looking good for Exxon Mobil. So let's go ahead and look at the balance sheet. Let's look at how they're doing financially speaking. What's really important is to look at their revenue, their net income, and especially their balance sheet, especially in a time like this. So their revenue over the last couple of quarters has had huge downturns. At the end of 2019, in quarter 4, they had $63 billion in revenue. That then went down about $8 billion in revenue to $55 billion. That then went really far down to $32 billion. And now they're at $45 billion. So you can see that's about a 27% downturn in just the last year or so. Not looking good at all. And then net income to shareholders over the last 3 quarters have been negative all across the board. Now, if we go to the balance sheet here, I want to look at the quarterly updates on the balance sheet. Now, I want to look at the end of 2019 before the pandemic took place, and I want to compare their balance sheet today compared to how it was at the end of 2019. At the end of 2019, they had $3 billion in cash, okay? If we look at their long-term debt, where is it at? Long-term debt right here is $30 billion. So at the end of the 2019 period, before the pandemic ever took place, they already had long-term debt that was 10 times higher than that of what their cash was. And now things look a lot uglier. So let's look at their cash and cash equivalents compared to their long-term debt now in the third quarter of 2020. They have $8.8 billion in cash, and their long-term debt is over $50 billion. So cash has only went up a couple billion, but long-term debt has went up over 60% in the last year to $50 billion worth of debt. And every single quarter that they can't produce at least 87 cents a share worth of profit and earnings per share, they are going to make that number get worse and worse and worse. And I really don't see any opportunities here for income investors, and this is why I think this is a dividend track. Now I want to compare this to a company that I own. Here, we'll go to my portfolio and we'll sort with my top holdings here. One of my largest holdings, kind of in the middle a little bit, 4% of my portfolio is made up by Caterpillar. Now they do sell some equipment to the big oil machineries and things like that. But Caterpillar had a huge downturn as far as their revenues and profits go in the beginning of 2020 when the pandemic struck. Now, this company continues to raise dividends every single year, and 2020 is the first time they haven't raised dividends in a very long time. And even just last year in 2019, they bumped it up about 20% as the dividend goes. But if we look here, they have to produce at least $1.03 worth of earnings per share to really even break even, to where they can pay that dividend, and then they have to make more than $1.03 per share to reinvest back into the business or even continue to grow that dividend in the future. Now let's go ahead and look at two of their last quarterly reports. They had a downturn, and the second quarter 2020 profit per share was 84 cents. So that was less than the $1.03. So that means that they are losing money temporarily. But if we go to the next quarter, if we go to the third quarter 2020 results, they had third quarter profit per share of $1.22. So while this company has a short-term downturn, they get right back to where they're going, and then they can pay out those dividends just fine and continue to reinvest back into their business. But when you have a company like Exxon Mobil that is not even close to getting back to a scenario where they can pay that dividend and still continue to be profitable, that is going to be a negative thing for shareholders. And this is where I think this is a dividend trap. I think it is really easy to look at this dividend yield and go, hey, that's awesome. They're paying a 10% dividend yield. And if you invest in this today, you might get 10% worth of your money in dividends, but you might lose 25, 30% of your investment over the course of the next 12 months. So I just really think this is a warning for investors that they should not be investing in this company if you're wanting to be a dividend investor. And even I think if you're a value investor, I don't really think that this has a whole lot of opportunity either, because we look at companies like Tesla. All the electric vehicle companies have been exploding recently in the last year or two, and Tesla is just a prime example. These companies are thinking of new, innovative ways to implement technology in new, cleaner fuel sources than just traditional old oil sources, fossil fuels. Now, if we look at these companies, we can see that they have excellent performance. They have growing revenue streams. They have a lot of different stuff going for them. Unless you're a Nikola, of course, and you're just a fraudulent company. But regardless, I think that these companies have great opportunities for the future. And these older companies like Chevron and Exxon cannot innovate into these newer clean fuel sources just because the flat out simple truth, they don't want to. Now, I think a lot of people have recently came out and have said that they think that Exxon Mobil should cut their dividend to zero. And honestly, I agree. It should go to zero. Not get cut 10%, 20%. It should go to zero. This company should be preserving capital just to be able to survive over the next decade or so. Now, I found on Seeking Alpha, I found an article here, and I highlighted this little area right here, and I wanted to read this. Even if the company delivers stellar numbers, which I'm sure of, the company is unlikely to be impressed because of the secular growth of concepts such as sustainable investing. This might not be what a loyal Exxon investor wants to hear, but there's no running away from the truth. Sustainable investing. Nobody wants to invest into a company that is not sustainable. One of the reasons why I invest in Pepsi, one of the reasons why I invest in Coca-Cola, is that they are sustainable companies. We know that eventually people are going to move further and further away from fossil fuels. Eventually we're going to go more and more electric and other clean sources. But people are always probably going to drive vehicles in some way, shape, or form. It just might look a little different. Now the thing, when we look at Pepsi, basically you can make the bet that people are going to need something to snack on or need something to drink. Pepsi is probably always going to be around, while a company like Exxon is in a dying industry. But if we go back here to this article, it says sustainable investing. You should never invest in a company where the question as to whether or not this company will be sustainable in the next 10 years is not something you should be asking, and it should not even be a consideration into your portfolio, no matter what the strategy. Now let's go ahead and read a little further. Contrary to the belief of some investors and analysts who believe Exxon should be slashing its dividend to save cash, I hold the view that the company will go to great lengths to keep its undisputed track record of dividend distributions intact. When I say great lengths, I'm thinking about assuming more debt or even divesting non-critical assets to raise sufficient funds to honor its dividend policy. At the same time, I believe that Exxon Mobil is not going away for quite some time as well. Yeah, we'll see about that. It will take multiple decades for fossil fuels to be replaced, if at all. For these reasons, I believe income-oriented investors should consider including Exxon Mobil into their portfolio for its 10% yield. Now, let's say I'm wrong. Let's say that these companies last decades. Let's say that they're around till 3000, year 3000. Let's say they pretty much never go away, right? If that's the case, where's the upside potential for this company? When we look at companies like Facebook, okay, an innovative company that has billions of dollars in cash, they keep on finding new innovative ways to grow their company. They use their capital to grow the company more and more and more. And they can do that from a ton of different ways, ton of different outcomes. Companies like Amazon invest into new technologies pretty much every single day, constantly coming out with new devices, buying out smaller companies. But when a company like Exxon, they only have one income stream. That's big oil. This is not a tech company. They can't produce a new app or a new technology. They can't produce new products or new resources that aren't related to oil. They can't just come out, and the same thing like I said with Caterpillar, they can't just come out and just start making bulldozers to compete with Caterpillar. This is not that type of company. If oil goes down and stays down, then this company is going to go down with it. If oil goes to zero, Exxon Mobil will go to zero far before oil will. And I think that this company paying out dividends is ruining book value, ruining shareholder value every single day that it maintains that dividend. And I think that this is a dividend trap for dividend investors or really just value investors in general. But thank you guys so much if you've made all the way to the end. I think this whole situation with Exxon is not a pretty one. And if you own this stock, I don't care if you're at a loss, you should consider selling. Don't have the sunk cost fallacy. And thank you guys so much for watching all the way to the end. If you want to subscribe, I invite you to do so. If you want to follow along with me and update these charts every single month, I have everything disclosed on the channel from all 26 companies that I own. These are the 26 that I currently own right here. And if you want to see my portfolio or even invest in it yourself, this is shared down in the description. We are now over $7,000 and we just received another $10 today because we had someone sign up with this referral link. So please go ahead and use that. Get that to 55 successful referrals. If you download M1 Finance and deposit $100 to the platform, you get $10 just for signing up. And like I said, I disclose everything in the channel. Buys, sells, winners, losers, dividends, everything you could possibly imagine. So if you want to see that and you want to follow along with me, go ahead and subscribe. I'll see you guys next time.